Welcome back to 701 Chain, FinTech for Financial Institutions. I'm Michael Lehn, coming to you from Miami, Florida at Consensus 2026, where I'm continuing to dive deeper into the world of blockchain and digital assets. I'm excited to welcome back Dhruv Bharagava from Crowe, and this week he brought along a fantastic guest, Dan McGonigal, Crowe's senior manager who previously spent 15 years with the Federal Reserve. Good morning, gentlemen. What are the themes that you guys have seen at Consensus 2026?
Yeah, it's always tough for me at these things. I'm not dodging the question. Like the very first question, I'm not going to answer this one. No, I always wonder, it's like, am I coming in with implicit bias and like, am I seeing stuff that I want to see and listening to the conversations I want to listen to? But I would say what I've taken away from this conference is just the idea of complexity and how that's involved. And I would say maybe two approaches I see with complexity. I think I've seen more vendors and had more conversations this week about those that are really trying to simplify what they're doing and remove complexity. And then there's others to where they just seem to be going headfirst into very complex stacks. And so I wonder a lot about that in terms of where we go as an industry, what ultimately ends up being the best use case. And then the other one is use cases. I think I've heard more intangible use cases for digital asset activities than I probably hadn't heard in a long time. Granted, I'm coming from a traditional finance background, and so I think that's the challenge for TradFi right now is understanding what are those use cases, and I'm seeing more and more of that. So that's what I saw this week. But again, I think I'm looking for some of that stuff too. So it's tough to say.
What you, Drew?
Yeah, I mean, I think I'll compare it to last week when we were at the Bitcoin conference, right? This one is a lot more institutional focused, and it's cool to see. I think we talked about this yesterday, maybe the day before, but in the past, these crypto conferences have been more focused on retail investors, the crypto bros, we'll call them the fanboys, and it's very different this year, right? There's very large booths dedicated to banks, traditional banks, like Dan was saying, companies that are there to invest in other businesses, institutional partners. That's kind of the theme in general, right? It's less focused on the everyday person that used to like to buy crypto and meme coins and things like that. It's more focused on how do institutions actually adopt it and build us into traditional finance.
Definitely more mature.
Yeah,
right?
yeah.
I've had a lot of conversation where people recognize that, right? Is that it's grown up a lot. Now I still think there's some funky things, and and you catch a few conversations or booths or outfits even where you're just like, wow, like you don't see that at most finance conferences. But I think that will always be part of the space, right? And that was just a lot of the origins of crypto in the first place. And so I think that's just the character, but definitely more mature conversations, mature ideas. And I'm excited to kind of see where it goes and come back next year.
Absolutely. One of the main themes around 2025 was the Genius Act, and now 2026 is the Clarity Act, and everyone's like, well, when's the Clarity Act going to be passed? When's the Clarity Act going to be passed? This week we heard there is finally an agreement within the Senate Banking Committee on the market structure bill, or what we like to call the Clarity Act. What are your guys' thoughts on that?
Yeah, I can start. I stopped handicapping these things a long time ago. I'm terrible at it. I think I heard a lot of optimism on the floor this week. But we had a great conversation at dinner last night. Shout out Professor Todd. Yeah. We all went around the table and kind of shared where we see this thing landing. And I think it's tough to say. There's still some very fundamental issues that need to be addressed. Obviously, it seems like there's been some progress on the yield conversation, and that's a huge sticking point for both crypto and the traditional banking industry. And so it kind of feels like there's some momentum that we haven't seen in a while, or at least the last few months. That it's reason to be optimistic about clarity. But I just think you never know. Like my personal mission, I haven't read the most recent version. And it's like, after spending so much time reading the last version, watching it fall apart in final markup, I'm like, I think out of spite, I'm like, I'm not reading this one until it's done. But I've caught a lot of the commentary, and so it will be interesting to see how it develops. I think a lot about kind of its implications for what I think about is regulatory perimeter, right? And I worked with a really brilliant colleague at the Fed years ago who wrote a wonderful paper around the regulatory perimeter. And the whole idea is that there's innovation and activity that happens inside that perimeter and outside that perimeter, but it's a lot of that activity that kind of congregates around that perimeter that drives where that perimeter is, and there's also kind of the reverse effect of anytime there's a resetting of where that perimeter is, then that has an impact on the competition around. And so I think that yield conversation is incredibly important in that context, and that's going to have some effect on the banking industry, some effect on what digital assets are able to do and be deposit-like, and we'll just see how it continues to evolve. I think regardless of where it lands, I think there are still opportunities for really creative, air quotes, solutions for what people can do with digital assets and the combination of yields or some type of financial incentive.
Yeah, I mean, I don't know that I have much more to add from an expertise perspective. Dan's probably the expert on this, but what I would say is that perimeter thing you mentioned, the guardrails are what are needed here because people are going to continue to build in this space no matter what, right? They're like the yield conversation, in my opinion, right? Again, this is completely my own opinion, reading what's happening on Twitter, the discussions on Reddit forums, and it's, people are like, we're going to come up with our own solution anyways. If the government says you can't have yield on a stablecoin, okay, we'll create a new product, right? That's the whole industry in general. So I think it's going to be in everyone's best interest that this passes. Now, I mean, one of the conversations we were having last night was political incentive, right? Is it in everyone's best interest to get this passed as soon as possible? I don't know the answer to that, but we'll see where it lands.
I think most people would agree we need to have something.
Yeah.
Right. And we need something here. And that, getting back to the conversation about what we've seen at the conference this year, it's way more mature.
Yep.
The toothpaste is out of the tube here. We can't continue to ignore it. And like you said, Drew, like we need structure, we need those guardrails in place. It's just kind of a matter of where that falls and how individuals and organizations will respond to that.
Yeah.
Absolutely. Kevin O'Leary, from Shark Tank, a lot of people know him as Mr. Wonderful, was on stage yesterday talking about the need for everyone, depending on whichever side you're on, right? More on the banking side, more on the digital asset side, or in the DeFi world. Everyone needs clarity. And another big point that he talked on, which I've also been kind of hearing this week and even last week, is this consolidation within the blockchain. And I should say within the blockchains, when you look at how many blockchains are out there, approximately 1,000, let's just say, do we really need 1,000 or do we really only need about a dozen or two? Because at the end of the day, I think if you kind of shrink this ecosystem down to a dozen or 2 dozen blockchains, it becomes much more simplified, and a lot of them are doing the exact same thing.
Yeah, I mean, like I was saying, this whole industry was built on building. So people are going to come out and they're going to build whatever they want to build. There will be, at some point, like you said, a consolidation. There is no need to have 100 different stablecoins, 100 different blockchains. It just doesn't make sense, right? What are we going to have? 100 different options for every person to process a payment? The credit card industry was that way at some point, right? And it consolidated down to 4 to 5 major brands. I think it's 6 internationally now, but the payment rails consolidated eventually. I think we're still very early. I think you said that the industry's mature. It's still not mature enough. I think we're still very, very early. Yeah. Like even the fact that we're talking about this now, right, without there being proper legislation and guardrails put into place, it says a lot.
Absolutely. Yeah, I mean, even looking at the 80s, right, there was consolidation within the banking communities. Kevin O'Leary was even talking about his personal portfolio on the digital asset side. He used to be at 27 different digital assets. Now he's down to 3, right? Because he believes there's only 3 winners out there. Now, there's obviously different use cases, right? There's a different use case for Bitcoin. There's a different use case for Ethereum. There's a different use case for Solana. Some of the other big players. But yeah, I completely agree with you. there is no need for 1,000 different blockchains.
I'll just add, from like a risk and compliance standpoint, it makes the job of risk managers incredibly challenging, especially when you start figuring in like interoperability and all of the different chain hopping here. Like I had a conversation with a headed FinCrime policy, and she's like, yeah, we're monitoring across 65 chains right now. And it's like, that seems untenable. Like, I don't understand like how you can expect people to effectively apply that. Now, you know, the tools out there are great. Obviously, automation and AI are going to help with a lot of that. But I think from a consolidation standpoint, some of it is very natural for emerging markets or evolving or maturing markets. But from a risk and compliance standpoint, again, this is my implicit bias here. Like, what's the risk in all of this? I look forward to those days when, you know, it's not 65 chains, and hopefully it doesn't go to be more that we need to monitor on a meaningful basis.
Yeah, absolutely. Last night we talked about this a little bit, and the big debate in the digital asset community about Circle and Tether in regards to them electing to freeze certain assets and not to freeze certain assets, and at what time do they freeze and what time do they not freeze. And recently we've seen them land on both sides of the table.
Yeah.
Drew, you want to talk a little bit more about that?
Yeah, I mean, I think the conversation started a while ago, right, when Circle froze. I think it was around 15, 16 wallets, and it was related to a court case, and there was a legal order there to freeze the fund. So Circle did what they were supposed to do from a legal perspective, and they froze those assets, and Tether said they would never do that, right? Now, more recently, there was a breach of the drift protocol. I believe it's being attributed to North Korea now, but in that instance, it was flipped, where Tether actually froze the funds and Circle didn't. And I was reading something earlier this morning that Circle's CEO came out and said that they would only freeze funds if there was a legal order to do so. Mm-hmm. So there's kind of been a change now, right? And at first everyone was like, well, Circle's not really abiding by the spirit of decentralized finance. And there's one entity out there that can freeze your funds that's not really decentralized at that point, right? It's traditional banking reinvented with some code added to it. But in this instance, right, Zach XBT, he's a forensic investigator that posts a lot of things on Twitter, and he talked about it. He's like, I think there's somewhere around $480 million in funds that have been moved through Circle's ecosystem that haven't been frozen, and all of these are funds stolen as a result of data breaches. So I think that there's some merit there to having the ability to freeze funds, but again, it depends on what side of the argument you land, right? Are you one of the people that believes in true decentralized finance where nobody should have that ability, or are you someone that's in favor of the guardrails that we were talking about, the structure, the perimeter that I think, Dan, you were talking about, right?
Yeah. I think this is really interesting conversation in the context of Genius too, right? In that, in the flurry of proposed rulemaking, you've seen the federal agencies come out and say payment stablecoin issuers need to have the ability to freeze and seize. But there's not a lot of direction, at least from what I've seen, on when or why to do so, right? And so I think that's a really challenging situation to be in for entities that have that responsibility or capability, but don't have that clear guidance. And you're likely having to come up with your own policy as an organization and how you implement that. And there's always, as we've kind of talked here about in recent situations, there's trade-offs between those. And that's not necessarily effective public policy when you have such disparate approaches to something that's very important. So I think hopefully we see a little bit more guidance here as the evolution of Genius and its implementation continues. But it's a really tricky issue to kind of say when and why. And I think in some cases, it makes sense, like OFAC, tying it to sanctions. When it's a sanctioned entity, then obviously you kind of follow existing requirements. But in others where it's connected to stolen funds and you're not receiving that legal order to take action, then
right,
it can be really difficult to discern, when you need to do so.
Absolutely. Some of the other big highlights that I've heard from Consensus was DTCC talking about tokenization, and them technically going live via a soft launch, I believe on July 13th. And then the other couple couple big announcements was Tether talking about they're actually starting to have conversations with community banks on stablecoins.
Interesting. Yeah,
So
wow.
that shocked me. And then Paxos talking about them working with some big players, and those big players potentially white labeling some of their stable coins. They didn't necessarily say that word for word, but just kind of reading between the lines with some of the quote unquote big announcements coming down the pipeline here in the next 60 to 90 days. Where do you guys see us going from now to midterms? I guess, how do you guys envision 2026 kind of recapping here?
Yeah, I'll say, like, coming from a policy and regulatory perspective, we're going to have hopefully a lot more information, say in like October, November, later this year. You know what? Hopefully by that time, Genius will be finalized. There's still a lot of work to do. Maybe we have clarity at that point. But I also think we'll see continued maturation in the marketplace. Like, you laid out some great examples, Michael, in that all of those examples, what I heard was the coming together of TradFi and DeFi in some ways, like especially with DTCC and having their own tokenization offering. Like, these are real institutional players that are taking on blockchain and digital assets. I think that's one of the most exciting things for me. Like, I spent several years focused on the combination of innovative activities in traditional finance, and seeing that come true in the digital asset space is a really exciting time. Now, there's a lot of work that still needs to be done, but I think we saw very similar patterns in the fintech partnership space, right? And that a lot of fintechs emerged and said, we're going to disrupt, and then it quickly gave way to something that resembled more partnership and collaboration. And I'm looking forward to that day when we kind of see that greater collaboration between TradFi and DeFi.
Yeah, I mean, I think looking at it from a little bit of a different angle, the tech perspective, right? I know you mentioned midterms. I don't know that there's a lot of political implications right now in general with, the midterms and the changing of the House and the Senate outside of the Clarity Act being passed, right? We don't know if it's going to pass before or after that, but I just don't think there's enough regulation yet. And that's a weird thing to say because, again, this space is very anti-regulation, or traditionally was very anti-regulation, but until there is more guidance and more regulation, and again, to use Dan's word, there's a perimeter set, there's not really anything that a political body can do to influence this space. I think it's just going to be a lot more innovation, a lot more building, and that's going to lead to this kind of merger between traditional finance and decentralized finance. I do think one of the other themes that maybe I didn't mention during your first question was the advent of agentic payments, right? AI agents being able to kind of process payments on behalf of a general consumer. And that's going to be something that gets really hot this year. I think that the conversation has started, but there's a lot more work that needs to be done, and there's a lot of payment brands investing money into this to make this automated payments a thing. So that's kind of, again, naturally going to lead to more innovation, more building. See where it ends.
Yeah, absolutely.
Lastly, I just want to maybe dive deeper into the weeds here on this news from DTCC. Knowing the amount of transactions that they run, and this was shocking to me that they run 4 quadrillion transactions per year.
Yikes!
And they plan on, like I said, technically launching via a soft launch on July 13th. I don't know why that specific date, but that's the date that they gave us. What does that all mean, of actually tokenizing assets through DTCC? I mean, they talked about one of the biggest opportunities would be the unused collateral. Can you guys dive deeper into that?
Yeah, I mean, I can talk about it from a tokenization perspective. I think it speeds up settlement, right? I mean, right now, a trade executing on just the traditional wires and traditional rails is it takes a while, right? It's the +1 rule where a trade settles the next day, the 24 hours. By tokenizing securities, you're kind of creating a new avenue there to settle things faster. And like you were saying, the unused collateral, right? It gives you access to more liquidity. I mean, that's the whole concept of tokenization in general, right? It's to increase a liquidity pool, whatever it be. You can tokenize, there's a lot of talk about RWA, real world assets, and tokenizing them, right?
Absolutely.
I mean, it just, what does it mean to actually tokenize a building or a car? I think when we were at the Solana event yesterday, there was a DeLorean there that had been tokenized. And I'm like, what does that even mean, right? I don't understand the concept there, but it does create this larger liquidity pool.
Proof of concept, right?
Right, yeah. A tokenized car. Okay, cool. Can I still drive it? And it's going to take me where I want. But yeah, I think it's just increasing the liquidity pool. I think one thing that we may end up seeing is the ability to purchase securities without using fiat, right? Or without having to use a traditional bank. So settling a security or a trade in stablecoin, that could be interesting, but I don't know where it heads from there.
I think this was part of the themes that I saw, is just the greater description of use cases, right?
Yeah.
And just like the tangible use cases that are at our fingertips. I hate to be like the risk guy and stick in the mud, and it's like, but I can't help but sometimes wonder, like, if we're settling the settlement problem, right? And it's not necessarily a problem. We just built our system around to settle on T-1, or if your ACH payments take a day or two to settle, then that we all kind of live with that. And certainly there's opportunities to, like you say, Drew, kind of expand the utility of capital and improve liquidity across the system, and that has meaningful impact. But I can't help but wonder if sometimes we're solving a small problem and then maybe creating bigger problems over here in the way of cybersecurity or operational resilience. And so I had a lot of conversations about that. I think that's what I look forward to in the maturation of the marketplace, is that we don't become hyper-focused on something like bringing settlement down to near real time at the cost of massive vulnerabilities. And I think everyone is paying attention in that space. We're seeing more attention on things like what happened with Drift and other breaches. And I think we're learning those lessons, and we'll continue to learn those lessons. But I can't help but like take a step back sometimes and think about the broad risk profile of some of this stuff and say, wow, like it'll be interesting to see like those approaches that are being taken and how people balance those things.
Yeah. I mean, I think that one last thing I'll add, right, again, from a technical perspective, it's just this industry in general, and I love the community, but I think we have a tendency to say our technology is perfect and it doesn't need change. Yeah. But I mean, the number you threw off, 4 quadrillion transactions a year. I don't know that there's any blockchain that can truly handle that volume or that throughput in an efficient manner, right? I don't think the technology is even mature enough to be able to handle that. So to your point, are we going to then evolve the blockchains or the underlying tech to be able to support this one use case, and in that sense create a bigger issue? I don't know, but yeah.
Well, and that, I'm glad that you brought that up, because that was actually a question that was brought up at Solana Accelerate, which was essentially a sub-conference, right, within the Consensus Conference, that since DTCC has only announced so far that they're launching on Canton, obviously with being at the Solana Accelerate, one of the representatives asked, well, how about Solana? And they're like, well, we're talking with many blockchains right now.
Right.
And to that exact point, I think they're going to need at least a good number of blockchains, not the full 1,000 blockchains that we were talking about, but maybe 3 or 4 blockchains, just to have different options.
Right. But again, to Dan's point, right, that's going to create a more larger attack surface from a cybersecurity perspective, right? It's more technology you introduce, the bigger your risk is in general. So, I don't know. It'll be interesting.
Well, thanks, gentlemen, and I apologize to our audience for any background noise. We're recording at Joe and the Juice, so I'm sure the juicer is catching some people off guard with the juicer noise in the background. But thank you.
Thanks, Michael.
Thank you for listening to 701 Chain. I'm Michael Lehn. If you enjoyed today's conversation, be sure to subscribe and join us next time as we continue exploring the future of banking, innovation, and digital assets. This recording is for informational purposes only. It does not constitute legal, financial, or investment advice.
The views expressed are those of the hosts and guests and do not represent any organization, including Bank of North Dakota. Please seek professional guidance before making financial decisions.